Hi, my name is Zach Ludoff, and I served as a senior financial analyst on the team.
Hi, my name is Nicholas Garcia, and I am the investment manager.
Hi, my name is Jeff Ernst, and I served as the senior data scientist.
In developing our investment philosophy, we considered the following restraints. First, we wanted our portfolio to remain beta neutral, regardless of market trends, because we theorized that in the long term, our portfolio would benefit from neutrality rather than a specific leaning. Second, we wanted to remain fully invested with little exposure to cash. Our strategy would have to have little exposure to the market and be fully optimized. In our research, we decided to use a strategy that focuses on beta and idiosyncratic risk based on the academic paper Betting Against Beta. Because we are limited to equities, our strategy would be to leverage our portfolio's risk by shorting high beta and high idiosyncratic risk stocks and buying low beta, low idiosyncratic risk stocks. This overall strategy would help us achieve beta neutrality in the market. To initiate portfolio construction, we retrieved the Russell 1000 stock prices and processed the returns of each stock for the last 10 years. Then we ran a Fama-French regression with the following factors: market risk premium to determine risk exposure in the market, small minus big to factor market capitalization, high minus low to factor in the value premium, and momentum to factor the acceleration of each stock's price. The Fama-French model allowed us to compare the betas we would expect and the betas we were given to use. We found a statistically significant correlation and decided to move forward with the betas given to us. The regression also gave us idiosyncratic risk, which allows us to begin a final stock selection. We ranked our stocks based on beta and idiosyncratic risk, and ordered our list to reveal stocks with high to low beta and idiosyncratic risk. Then we created a portfolio that shorts 100 of the highest beta and idiosyncratic risk stocks while longing 100 of the lowest beta and idiosyncratic risk stocks. We then optimized the portfolio so that we would remain beta and dollar neutral. We continued to rebalance our portfolio bi-monthly to ensure that each stock remained at 5% or less of the unlevered portfolio value.
Using our predictive model, we performed a backtest of the portfolio performance by simulating the fund's returns over a period of 2 years. The market-neutral portfolio produced a realized rate of return of 14.7% on an annual basis. The backtest showed that the returns of our short positions in high beta securities were mixed during the 2-year timeframe. The high beta securities significantly outperformed during bull markets, leading to a rise in our short positions that outpaced the rise in our long positions. During bear markets, however, the strategic positioning of the fund allowed it to outperform. Stocks that exhibited both high beta and idiosyncratic volatility fell faster than our positions in low beta, low idiosyncratic risk equities. Setting beta at 0, the market-neutral portfolio backtest produced a Sharpe ratio of 0.44. We found the primary driver of returns to be the long positions in the low beta equities and our short positions in high idiosyncratic volatility securities.
For our portfolio optimization, our team established a set of constraints based on a pure market-neutral approach. We also concluded that our portfolio need to only hold enough cash to pay our short position dividends. Thus, our portfolio was set to have a beta of approximately 0, initially remain dollar neutral with variance of 1%, to have volatility less than 5%, and to remain fully invested during the course of the competition. The objective function of choice for our optimization was the expected return of the total portfolio, and we attempted to maximize this value subject to all of the constraints listed. We first ranked this universe of stocks in terms of beta and idiosyncratic risk, producing a list of securities to long and short. Our portfolio optimization took the top 100 stocks based on high beta and high residual risk, and set a constraint that assigns weights to these stocks of less than 0. We then did the same thing for the top 100 low beta and low residual risk stocks except this time assigning them weights greater than 0. We then set a constraint that the sum of all weights must equal 0. We then set a constraint that set the total amount to be invested of $1 million long and $1 million short, so that the weights remain 0 in sum, but the total dollar value allows us to remain fully invested. For our initial trades, we took these stocks' optimal weight and we found the optimal amount to be invested. By taking the optimal amount and dividing it by the current share price, we obtain the amount of shares to be purchased. Once in place, we manage the portfolio gains and losses based on whether the absolute value of the gain was greater than 15%. The total portfolio return during the competition up till now was 0.88%. Our portfolio value is now $1,008,700 with a beta of 0.04 and a Sharpe ratio of minus 0.22. Our alpha sits at 0.59%. The top 3 stock picks that we made were Herc Holdings, where we made 25% in return, Fitbit, which we made 20% return, and OneMain Holdings, which we made 19% return. These 3 stocks are not all long and short. Herc Holdings was a long position that unexpectedly outperformed the broad market and our expectations. Fitbit Holding was a high residual risk, high beta stock that we shorted and did well during the time period from a short perspective. OneMain Holdings was one of our picks that we decided to overweight based on its current market condition. The bottom 3 stock picks we had were Kate Spade & Company, Skyworks Solutions, and Acadia Pharma. All were short positions. For Kate Spade & Company, the minus 27% return happened unexpectedly. We had obtained a return of 14%, but company news switched the direction of the stock, and in late December, the price of the company's shares started to rise. For Skyworks Solutions, we took a negative position in it based on its idiosyncratic risk, and that position did not hold out. Acadia Pharma was a high beta and very high residual risk stock that outperformed in the second half of the competition. In conclusion, the attribution of our portfolio can be described in terms of active and portfolio risk. The benchmark risk of our portfolio was completely diversified away. This was through our strategic optimization. The total risk of the portfolio was 4.7%, with active risk of 4.7% as well. Our largest contributor to our active return was the size of the company, and then the exchange rate sensitivity and medium-term momentum, which didn't contribute much. The size of the company was mostly dependent on our low beta stocks, which were utility companies, and their market cap led to a lot of our return. Our top 3 industry returns and their contributions to our return were the multi-utilities, biotech, software industries. Multi-utilities made up a large part of our low beta portfolio, and biotech made up a large part of our short positions. Our position in the biotech industry was largely made up of our short positions, which a few outperformed, but most of them underperformed the market, leading to a large return in that case. Our software position was mixed, and with some positions long and some positions short. And finally, our portfolio characteristics. Our market cap as of today is $152 billion, with a dividend yield of 2% and a P/E ratio of 20.15. We want to thank you for listening to our presentation today, and we hope that you make an investment in our market neutral, dollar neutral portfolio. Thank you.